My role as an investment portfolio manager is to maximize the return of a portfolio for the risk we take. This is something that can be visualized graphically by plotting different investments or portfolios to see their relative returns and risk. Return is plotted on the vertical axis, while risk, quantified by standard deviation, is plotted along the horizontal axis. All else equal, we want a portfolio that provides a higher return at the same level of risk, so moving straight up on this graph, or a portfolio that generates the same return with less risk, so moving from right to left on this graph. With this in mind, the strategy I employ is to build a portfolio that's expected to deliver solid returns relative to risk, and then, if that return or expected return is insufficient, use capital efficiency to target higher returns. My approach differs from the conventional approach to building investment portfolios, which relies upon a combination of stocks and bonds. The conventional approach suggests holding a greater percentage of your portfolio in stocks if you have a long time horizon and high risk tolerance. And then, as you approach retirement or as your time horizon shrinks, or if you simply have a lower risk tolerance, in that case, you should hold a greater proportion of your portfolio in bonds. Using data from mid-1996 through 2024, you can see how these conventional portfolios composed of stocks and bonds would plot on the risk and return graph. Here we're looking at different combinations of stocks and bonds in 10% increments. So starting at 100% bonds, up through the 60-40 portfolio, all the way to 100% in stocks. A key item to note on this graph is how the line flattens out as you approach 100% stocks. At the lower risk levels, as you add stock exposure, you get a better boost to returns relative to the additional risk you assume. You're moving up in this graph similarly to how you're moving to the right. But as you increase your stock allocation to 50%, 60%, 80%, and ultimately 100% in stocks, you start adding a lot more risk relative to the additional return you're getting. You're moving further to the right on this graph than you are moving up. We want to be well compensated for the additional risk we are taking, rather than taking a lot more risk to eke out a marginal return. This loss of return efficiency, or this flattening out of the curve, is a result of concentrating into stocks and losing the benefits of diversification. So with all this in mind, if your goal is to increase expected returns, an alternative to concentrating your portfolio in stocks is to apply capital efficiency or leverage to a diversified portfolio. If you're able to borrow at the risk-free rate, or essentially what a high-yield savings account would give you, then borrowing at that rate to increase your exposure to a diversified portfolio allows you to preserve the risk-reward characteristics of the diversified portfolio in pursuit of those higher returns. Graphically, this looks like moving in a straight line, starting at the risk-free rate through the diversified portfolio and beyond, instead of flattening the curve. So going back to one of the first graphics in this video, we'd like to move along the dotted line by using capital efficiency in a diversified portfolio, instead of flattening out this curve by concentrating into stocks. While the idea of leverage may understandably scare off some investors, it's important to understand that we're talking about applying a modest amount of leverage to a diversified portfolio that has historically been far less risky than a conventional 60-40 or 100% stock portfolio. And I'd also like to note that the idea has been theorized since the 1960s and has even been put into practice by institutions like pension funds or hedge funds for decades. If you search the internet for something called the capital asset pricing model, you'll find a lot of pictures like this, very similar to the graph we just looked at. So the idea isn't new, but what is relatively new are ETFs and mutual funds available to virtually all investors that allow you to employ this strategy. So let's review how this theory can be put into practice. As I mentioned earlier, my investment strategy involves building a highly diversified portfolio, and then if you're targeting higher returns, using capital efficiency or applying leverage to that highly diversified portfolio. This highly diversified portfolio is built upon what are called risk parity principles, and that involves combining and balancing diverse asset classes that respond differently to major economic environments. Major economic environments can broadly be categorized based on changes in economic growth and inflation. Stocks tend to perform well in periods of above expected economic growth. Treasury bonds tend to perform well when growth and inflation come in below expectations. And certain alternatives like gold and managed futures have tended to perform well during inflation shocks or prolonged bouts of inflation. Risk parity style portfolios will include assets with diverse exposures to these major economic environments, and then strive to achieve balance by weighting these assets based on how often we're in these environments and how volatile each individual asset is. For example, stocks and gold tend to be far more volatile than bonds, so a risk parity style portfolio will tend to hold a lot more in bonds than stocks or other more volatile assets. A rather simple, but good enough for our purposes, risk parity style portfolio would include 30% stocks, 55% in bonds, and a 15% split amongst gold and managed futures. So how does this risk parity style portfolio compare to the stock and bond portfolios we reviewed earlier? Here's where the risk parity style portfolio falls for the same time period between mid-1996 through 2024. The risk parity style portfolio generated a lower return than a 100% stock or 60-40 portfolio, but it was also far less risky or volatile compared to these conventional portfolios. The risk parity style portfolio achieved a return of about 6% per year compared to 6.9% per year for a 60-40 and about 7.9% per year for the global stock portfolio. So the 100% stock and 60-40 portfolios achieved greater returns than the risk parity style portfolio. But these portfolios also experienced far greater volatility and drawdowns. The risk of the risk parity style portfolio, measured by standard deviation, was about 2/3 of the 60-40 portfolio and only about 1/3 of the 100% stock portfolio. Put another way, you would need to lever up the risk parity style portfolio over 1.5 times to match the risk of the 60-40. And you'd have to lever up nearly 3 times to match the risk of a 100% stock portfolio. These relative risks translated to a maximum drawdown of only 13% for the risk parity style portfolio, compared to 30% for the 60-40 and over 50% for 100% stocks. So now let's look at how applying leverage to this risk parity style portfolio would stack up. Here's where the 50% levered risk parity portfolio would fall in the graph we looked at earlier. As you can see, the use of leverage allows us to preserve the diversification benefits of the risk parity style portfolio while increasing our returns. We are moving from the cash or risk-free rate through the risk parity portfolio in a straight line instead of flattening the curve through a concentrated strategy. In this example, by applying 50% leverage to the far less risky risk parity style portfolio, we end up with slightly lower risk compared to the 60-40 portfolio and only about half of the risk of the 100% stock portfolio. And that lower risk is also borne out in the standard deviation and maximum drawdown statistics. The levered risk parity style portfolio produced greater returns than the 60-40 portfolio with less risk, and it produced similar returns to 100% stocks but with significantly less risk. Through exchange-traded funds, or ETFs, this investment strategy has now been made available to virtually all investors, and it's a strategy I employ in constructing investment portfolios. If you're a conservative investor, perhaps an unlevered risk parity style portfolio is best suited to your needs and goals. But if you have a higher risk tolerance and want to shoot for higher returns, in that pursuit, we apply modest leverage to a diversified portfolio. Ultimately, this strategy aims to provide the maximum returns for the risk we take. From a financial planning perspective, better returns for risk leads to greater certainty in our planning outcomes and a smoother, less volatile ride for our investment returns. Thanks very much for watching.